Hello, everybody. Welcome to Wall Street Hackers, one of the most popular shows on the Pod TV network, which broadcasts in the United States into over 120 countries. And all 120 countries are following what we follow, which is the markets. And of course, not only we look at the stock market, we're also going to look at the stories of the week, quotes of the week, and also Peter's pick, what stocks you may want to look at to add to your portfolio. And then, of course, we'll have our panel discussion. We'll end it. And this will all take place in like 1/2 an hour. So with that, we're going to bring in the hacker himself, graduate of UCLA, who received his degree in economics. He also went to the University of Miami, where he received his law degree, and New York University, where he received an MBA, with an emphasis, I hope, on finance. And then after spending 17 years slugging it out in Manhattan, I guess after you do something for 17 years plus, he finally fully understands what's going on in the stock market. So let's bring in the hacker himself, Mr. Peter Bennett. Peter, welcome to your show.
Hi, Nick. Hi, audience. No, actually, I took a MBA in pottery and a law degree in art history. No, just kidding. Anyway, welcome to Wall Street Hackers 7/11/24 edition. You can catch a new edition of Wall Street Hackers, depending on your distribution channel, on Thursdays at 1 or Saturdays most weeks. So markets, as been pointed out for a while in Wall Street Hackers, and it's so obvious in the market, AI is pretty inflated, but not necessarily wrongly inflated. But we're going to cover a fair amount on AI this show because it's such an important part of the audience. As pretty much everybody's pointed out now, and our show, it's been a huge contributor to the growth in the S&P 500. It's been keeping the market up and higher, although not that high against inflation, but still a lot of the progress in the market, at least nominally, has been due to the AI. So I want to say now that this is not a prediction on AI, because the thing is, it's our philosophy, Wall Street Hackers, to take pretty certain bets, because I don't like to lose money. And the thing is that I really don't know if AI is finished or not, the AI play. I do know that there's more risk than there was a few years ago. I was in AI for a while and did well with it, but then I was out of it and then missed some of it, but did very well with MG anyway. But the other side is, and this week we're actually having my first AI play in a while, but is with options, so it's a little safer than just an outright play. So, but there's a lot going on. First of all, the market is definitely getting more skeptical about AI. There's more news stories, more analysts who are coming out saying, well, maybe we're all a little overinflated. So we're going to cover a few different aspects of that first, because it is such an important part of the market, not only in terms of growth, but if AI collapses, maybe the market will collapse. If AI really tanked, it could be 20 or 30%, adjustment to the market, at least 10. And the thing is, as of this morning, QQQ was down about 2%, and the market was down 1%. It could be the beginning of the AI drop, but who knows? But listen to all this evidence. So, number one, quote of the week, and there's a bunch of quotes of the week here, and they're almost all just slightly edited at most. Wall Street is becoming more skeptical of artificial intelligence hype helping to power stocks. Analysts are starting to express concerns about AI, a trend that became central to the stock market success in 24. After 18 months of hyping artificial intelligence and its potentially transformative impact on corporate profits and human productivity, Wall Street appears to be turning more skeptical, what I said. Some analysts are questioning the central premise of the AI revolution, with Goldman Sachs' Jim Covello, the bank's global head of trading of equity trading research, expressing doubts that the technology will be profitable or influential, as its boosters claim. This is a really negative take on AI. He said, quote, many people seem to believe that AI will be the most important technological intervention of their lifetime. But I don't agree, given the extent to which the internet, cell phones, and laptops have already fundamentally transformed our lives. That is an important point I've thought of. I mean, we already have the internet and phones. And so, how much will AI add? Nobody knows. Covello estimated that companies will have $1 trillion on capital expenditures related to AI over the next few years. To justify this immense cost, AI must demonstrate the ability to solve complex problems, which it simply isn't designed to do, he said. Again, Wall Street Hackers isn't saying sell your AI stocks, buy your AI stocks. All we're pointing out is there is more risk in AI stocks than there was a few years ago before this big run-up. Here's what Citibank, and also, Citigroup, they're called either one, analysts said. Stocks with high exposure to AI have a, quote, lofty but not bubble-like backdrop. And Citi analysts are estimating that the market is pricing in 19 to 27% growth over the next 5 years. This article didn't say annualized, but I'm pretty sure they mean annualized. But almost 60% of the market cap of the AI group has market implied growth rates that are above consensus. So what Citigroup analysts are saying, is the market is pricing in a lot of implied growth, and it's more than the consensus of sell-side analysts. Citi says, in particular, that the following stocks, I just picked a few of them out, are off balance in terms of higher market expectations. Microsoft, the analysts are saying 18% growth. The market is expecting 29% growth. That's a big difference. NVIDIA, 4% versus 7%. Tesla, 4% versus 12%. Those are hefty differences in terms of valuations, because they're compounded. So when So stocks where the analysts at Citibank said the market is estimating growth roughly correctly include AMD and Amazon. And we have a first tech pick in a while on Amazon. I like Amazon. I have an options play, which is also rare for Wall Street Hackers. It's not our usual philosophy. Well, I'll talk more about that later, but I do have an options play on Amazon that I got into. It was before this morning, but I also got in a little lower. So we'll be talking about that. Going on further about AI. Broadcom warned in March, quote, there is no tangible business case for enterprise AI. Quote, there are lots of AI initiatives, but it's still wait and see game. The implication of this is AI spending, CapEx spending, could slow and fail to meet expectations, which are pretty high. More. A recent survey by LucidWorks, and it's a June survey, finds that applying the technology has presented some unexpected challenges, including dangerous hallucinations, in other words, unreliability, and incredibly high implementation costs. In 2024, business leaders are slowing down spending to balance benefits, costs, and risks of the relatively new technology, close quotes. And most notably, according to this survey, 43% of surveyed firms were, quote, concerned about the implementation cost in 24 compared to only 3% in 23. So 3% in 23 were concerned. Now 43% are starting to think about it. 36% of surveyed firms were concerned about the response accuracy compared to only 7% in 2023. In other words, they were having hallucination concerns. That's what it's called. And I've dealt with AI, and maybe you call a call center, and that's why you want a person sometimes. I don't think it's there necessarily. So again, Wall Street Hackers isn't saying AI is going to grow faster or slower because nobody knows. Anybody who says they know doesn't know. In other market news, in terms of unemployment, nothing new really there. It's slowly climbing. It's around 4.1% right now, but it's still well below the last decade's average. Shelter inflation is still much higher than 2%, and that's far off the market that the Fed wants to see. And the shelter inflation makes up 36% of the overall CPI basket. So bottom line there, the economy is starting to slow. It's a really good question. Again, a danger, but nobody knows. Will inflation stay up and the economy slows? That would be stagflation or worse, and that would not be good for the market, obviously. But we still have very low unemployment historically, inflation over the Fed's targets, energy prices are healthy and probably going up this summer, and certainly there's danger of that. And of course, there's massive, massive government spending, which is off the charts and going to be that way for probably maybe the rest of our lives. We'll see. But it's really out of control right now. So we'll see where all this goes, but there's certainly risks, but that doesn't stop Wall Street hackers because we get into the what to do segment. And our philosophy is, go with dividend stocks, go with healthy businesses with good cash flows that are defensive. And we've been mentioning for years now, since we've been on the show, our favorite study, which says that for the 50 years to 2022, dividend stocks outperformed the S&P 500 for that 50 years by double, and dividend growth stocks and initiators tripled it. So great, that was a good study in terms of our philosophy. But this week or so, we came across a new study from Morningstar, another credible source. They studied 96 years of history of the stock market between 1927 and 2023. The annualized returns for non-dividend payers were 8.7%. For mid-yields, 10.3%, and for high yield, 10.9%. You might think, well, okay, an extra 2.5%, 3%, a little over 3%. But when you start compounding that over the years, it's huge. Whether it's 10 years, 20 years, especially 96 years, because over 96 years, the high yields outperformed the non-dividend payers, not by 2, 3, 4, 5, 6.5 times. So you won't get 6.5 times in 20, 30 years, but there's a pretty good chance you'll get a much higher return based on history. Our philosophy is right. You stay with dividend payers, stay with dividend growers, stay with obviously defensive high cash flow yields, and also companies. And of course, we've also talked a lot about why energy pipelines and producers and energy in general has been where a lot of the growth has been. So, so far, I see nothing that would change our philosophy. Interesting stories of the week. We're only going to do one this week because I spent a lot of time on the AI and also the Morningstar study, and we're going to get into a little bit more on the Amazon play this week. It's a little more complex. So, and we'll have time for a discussion of the week, which sometimes we always have to cut it short. So, this one was interesting story of the week. Holiday air travel exceeded projections. The TSA expected to screen more than 32 million travelers at U.S. airport security checkpoints in just the days from June 27th to July 8th. That was 5.4% more than 23 holiday volumes. From Thursday through Saturday, it screened nearly 8.5 million passengers, 3.2% more than last year. So bottom line there, that doesn't sound like an economy that's rapidly slowing. Maybe, probably slowing, but doesn't look like everybody's, tightening their wallet enough to keep inflation way down, with everything else going on, unemployment and government spending. So you get a quick break here. Okay. Moving along, our income pick of the week, our normal disclosures. Wall Street Hackers is for entertainment only. There are no guarantees on any of our suggestions, and there's no guarantees on anything except for a CD or a bond, and even then you have risk to principal if you sell it early. These are only our opinions. Consult your financial advisor. So this is very different than our usual pick. Very rarely do we do anything outside our core philosophy, which is to buy into businesses with good cash flows, high dividends, growing dividends, and that we can hold for life. But this is a speculative play. And when I mean speculative because you don't want to risk too much on this. And, we have a variety of investors. So some people, this may be new. Some people may say, well, you don't have to tell me this, but I need to cover it for a wide variety. So this is very speculative, but this play, I'm going to get into it, it's relating to Amazon. The most I could lose with this options play is 3% roughly in my portfolio in a worst case scenario. And the market and Amazon would have to tank to get that way. But on the other side, I won't get as much upside at Amazon, but I'm willing to take it because I'll get a fair amount if Amazon just stays flat, goes down a tiny bit, or it goes up. And it's a long-term play. We're talking about a December 26 option play. So in 2.5 years, I don't think Amazon will be down a lot. I wouldn't be surprised if it's flattish, but I do believe in Amazon, and I'll tell you why. And I like it much more than the other tech stocks right now. Of course, I'm not an expert on all the tech stocks. I'm just talking about the Magnificent Seven and maybe a couple others I've looked at. But number one, I think that Amazon is less likely to have large antitrust issues. There's a lot of competition in the cloud. There's competition in retail, even though they're pretty dominant, but they're less than, they own, I believe it's about 40% of retail sales is Amazon, which is a lot, but it's not dominant. It's not like they don't have competitors. Other competitors are constantly in there, like Walmart and other developing things. So you can't say they're dominant. They can't certainly price anything they want. Two, they've been brilliant at execution. You know, they have very successful businesses with AWS, and which is their cloud business, and also in retail. And I've seen other executions I like. Number three, they have a pretty reasonable price when you look at the cash flow. Cash flow over price is 23. So basically, they're earning about 4% free cash flow. But what I do like is that that's with a huge amount of investment growth, potential. They're putting in a lot of money. They're still earning 4%. Things get tight, or if things don't work out in some businesses, they could cut back a little, or they'll have success in a lot of the businesses they are building, and that will just keep compounding, the growth. Debt to assets is a low 0.16. So that's really good for a company, generally very low debt. But here's the key for me. And this is really a long-term play. I'm not even saying in the 2 years the options will expire in 2.5 years. What I see in the long run is Amazon could easily be the leader in future consumer robots. We're talking about household robots. They currently employ 750,000 robots right now and 1.5 million people. By the way, the robots are increasing and they've been replacing some of those jobs, but 750,000 robots. So they have a lot of experience with warehouse robots. Number two in that area is they also recently discontinued the Astro security robot for business because they want to focus on household robots. And that's where the big money could be made. They introduced a robot called Wally. It's pretty amazing. If you Google it, you can see videos of it. It's a small little robot. I don't know about that high, maybe, who knows. And it has a screen. It has Alexa capability, so it talks. And what's interesting is they set up a very complex maze of cones, extremely complex and windy. And the robot, Wally, just went right through it, the whole thing, didn't hit a single one. They put a vacuum cleaner or two, an iRobot in there, and it like crashed into the cones, whatever. Then in the demonstration, after going through this complex set of cones, the podcaster, let's say, who was doing the demonstration, said, "Follow me." So then Wally follows him outside in the street. He navigates over the curve and figures things out. And so the bottom line is, if you combine the capabilities of Wally with the dexterity, and intelligence of the warehouse robots, I mean, they're incredible already. Maybe 3 years, 5 years, they start coming out with consumer robots. I don't know the time frame. But at some point, the consumer robot industry could be bigger than any other industry or up there. And it's just waiting to be hatched. So eventually, I think Amazon will be a leader in that. I wouldn't be surprised. And either way, if they have a solid cash flow and good, execution. So what is the actual play? Again, very speculative. Some people shouldn't be buying or selling any options. It is either too complex for them or they don't want to take any extra risk. It all depends on your portfolio. You have to consult your financial advisor. So, but what I did is for 3% risk in a worst case scenario, again, what I did is I sold puts on Amazon for December 26th at 200. And I got about $30 in premium per share. So I collected $30 right away. Basically, if I hadn't covered, that means every share I made $30 on. Now, if Amazon goes below 170, I'd start losing money. I also covered by buying puts for the same date, December 26th, at 120 and 145 to limit my risk in case there's a cataclysm. I don't see Amazon going below 170, but who knows? Geopolitical tensions, something else goes wrong. You never know. So I don't want to take that much risk. I just don't like risk. But there's several points here for you. One, if you don't like Amazon, you can do this with any stock. By selling puts, it limits your upside, but you can do it at the price. By the way, Amazon was at 195 today. So basically, the puts at 200, if it just stayed flat, it'd do well. But you can obviously buy shares in stocks and just hold them. You can buy calls, but you can also lose more in them, options or leverage plays. So I think I like the play. I'm not a big speculator. Again, I'd rather just buy and hold, but it's an interesting play. Other points, especially for beginners, is one, watch your margin power, because if you use options, you can really lower your margin power. And that's important, because if you get too tight on that, you'll get calls, you'll get squeezed. We have to sell some options or some stocks. You don't want to do that if you're not experienced, and watch your leverage. But these selling puts can be a very good way to implement your income, add income, and if you like stocks particularly, and you're not sure they'll be up, but you think they'll at least stay flat, that's the play. Okay, panel discussion of the week, and we actually have time, Nick, to complete this week. Nick, if you come on, the panel question of the week is the longest I think we've ever had. I'm going to read it. In an unethical and often fatuous mainstream media, is an unethical and often fatuous mainstream media driving the Democratic Party towards unpopular, progressive, and sometimes ineffective policies, or are progressive Democrats pushing the media to take often poor and sometimes ridiculous positions? Background. The Democratic Party used to be run by moderates, and it often supported middle-class workers, middle-class goals, and their interests. It has swung to the left. I don't think even Democrats would disagree with that. They may like the swing to the left, but it's swung to the left on many issues, including crime, open borders, almost unlimited government spending, on late-term abortions, and on allowing genetic-born males to participate in female sports and enter locker rooms. The mainstream media, on the other side, including the New York Times, CNN, many television newscasts, many radio newscasts, and especially almost totally constantly off the deep end and totally absurd MSNBC. I mean, I watch it and I go, oh my gosh, they just make stuff up. Even Democrats would say that, Democrat writers might say, well, you're making it up too much. It's too much. People won't believe it. They are off the deep end. They've been pushing false stories for years. Examples include Russia is one. I don't know if I number them or not, but one, Trump is a Russian surrogate and working for Putin. Number two, Trump had absolutely no right, even though he's president, to ask why Biden said on TV, I've seen it, he said, something like, I'm proud to that I've arranged to fire the Ukrainian prosecutor. Now, that prosecutor was going after Burisma, the energy company that his son and the Biden family took in $5 million for. That affects international relationship. And I think Trump had a right to at least ask, is something going on here? Just because he said to the Justice Department, is something going on here? They impeached him. Wrong. Number three, COVID from China was supposedly a totally Republican conspiracy, and it was racist to say it was from China. Of course, now we know it was almost certainly from China, as I knew, because I don't believe the liberal media too much, but I do see what they say and once in a while. Number four, Hunter's laptop was a Russian conspiracy. Again, with the Russian conspiracy. It was real. I knew it then. It was recently used in a court case. If it wasn't real, it wouldn't have been used in the court case against Hunter. So total fib. Number 5, they actually pushed this. Trump is recommending injecting bleach into your veins to prevent COVID. It was a joke. It was definitely a joke if you watched it. He has a sense of humor, and sometimes he says things that are really silly, but he likes to be humorous. And they took it seriously and pushed it. Finally, number 6, and we all know a lot of people would say, well, there's another one. Biden having any health issues at all was a Republican and conservative conspiracy. And the videos of him previous to the debate were all fakes. The White House pushed that. The news stories pushed it. So it's not like the media has pushed these often incredible stories once or twice or briefly. They've pushed many of these stories for years, many for months and many for years. And many Americans really believe them. I can only debate so far with some people who just only eat up that media and go, this is real, this is real. Trump really used bleach or something. It's just too incredible. So, Nick, is the media driving Democrats, or are Democrats pushing the media to many far left positions? What do you think?
Yeah. I think they're going hand in hand. I mean, if you find out some of the people that are there, what you're saying is that the media is lying on the left. Well, what a surprise. They lie on the right, too. I mean, when I was listening to Fox News, I couldn't imagine Laura Ingraham and many of the misstatements and misrepresentations she made throughout her program, including one call that, the Republicans are going to win the Arizona, they're going to win the Arizona governorship. I guarantee it. No, they didn't. And so it was hard.
Wait, that's not a lie. That's not a lie. That's
well, they didn't. Okay, and
no,
so
I know.
the thing is,
that's a different level. And by the way, I don't agree with.
I mean, if you go watch Fox right now, Peter, you'll see the right coming down, lying all the time.
Wait. No, I have to hold on. I have to jump in here. A couple of points. One, I focus on Fox Business, not Fox.
Fox Channel. Business is different. They're talking about.
They're different, and also I want to make a point. Very important point, because we need to distinguish this. We're going to get to Fox. I watch Fox daytime. Fox nighttime. Here's the key, and they say this many times. If you watch enough, you'll see it plenty of times. They say, and I know, we are opinion shows.
That's
the
right,
shows at night, Hannity and Laura Ingraham, and the different shows there. They're right on some issues, they're wrong about some issues, but they say we are opinion shows. We are not news. If you want to see news, you have to watch daytime Fox, which is not opinion news, but mostly I watch Fox Business. The other thing is they are wrong about things, and I disagree with them on issues. Listen, if Trump gets into office, I want to point out, I will criticize some of his policies, but it's such a small percentage compared to what, the massive errors the Democrats are making on crime and open borders. But go ahead if you want, but we're running out of time now.
Well, just the biggest problem I've seen is Project 2025.
Oh, yeah. Okay.
They have made statements about it that I have not been able to find validation against. If you ever read it, it's not.
Are you looking at MSNBC or Fox?
It's actually MSNBC, CNN. They're all.
Yeah. No, I wasn't going to mention that.
Project 2025. Okay?
Let me jump in, Nick, because we only have a minute and a half left. I have to jump in again. We need 20 minutes to talk about this stuff. But yeah, I was going to mention 25. They make up this story. You know what they based it on? Trump made a joke. He said, the first day I'm going to be a dictator. After that, I'm not going to be a dictator anymore. And now they have this Project 25 that says he's going to be a dictator the whole time. He's going to be a king. It's so ridiculous. So I don't even know if I can reach the conclusions now. But number one, the country's facing serious challenges. I mean, we're talking about debt of $125 trillion off the books. And it's not 35 trillion, as many media, including Fox, makes a mistake on that a lot of times. And economics forecasts say China may be bigger than the United States by 2040 economically. We have geopolitical problems. We have all kinds of problems. And we need serious discussions, but we're not getting them because, first of all, the Democrats are off the left on deep end, and we're talking about a lot of issues that we shouldn't even be focused on. We need really good planning strategies, and we need to get the country together, which is obvious, but we're not going to get together if we're arguing about things like open borders and crazy issues. We have to get to the really complex issues that make up the reality of what we're facing. So I kind of did it. We're out of time, but we kind of squeezed it in. Thanks for watching Wall Street Hackers. And as Kim always says, get healthy, get wealthy, and be careful with that Amazon trade. I like it, but I don't love it. It's speculative. So we'll see you next week. Bye, Nick.
Bye-bye.